What's up, guys? Mike here again. I'm going to talk about Pinduoduo today. I actually bought a 7% position in it, and part of that was moving money over from Alibaba, and part of it is a new purchase. So I'm going to talk in this video about why I made the purchase, some of the things I really like about this business. I actually think this is one of the best businesses that I have researched in a long time. I'm actually very impressed, and in the second half, I have a 3-part thesis with one part that I have not read anywhere. I have not seen videos on it, so I'm either wrong or I think this might be, if I'm right, this might be a big deal. So if you want to skip ahead to that, I'll put some timestamps in. But yeah, let's get on with it. I guess I should first warn you guys that this is not investing advice. I am just a guy who posts videos on the moves I make with my own portfolio, and I might not be that smart. It's also not smart to invest in YouTube videos, so please don't do that. Do your own research. Now, speaking of not smart, I have a fairly big position in Alibaba. I've had for a while, and I am quite stupid because I did not research this company before. And that's stupid for a couple of reasons. One is that I believe if you own a company, you should understand the competition. This is just one of the things that I believe, and I didn't do it here. So that's the first stupid thing I did. And as a result of that, I paid a higher price than I could have for Pinduoduo, which I just bought at about 71. The average price is about 71, and I could have got it substantially lower if I had done the research early. So, in the stock market, your mistakes cost you money, and I think this has cost me money, and yet another lesson in the bank. Okay, so again, I'll do an outline of the company and some of the overarching things that I see, and then we'll do the thesis after that. Okay, so I'm not going to do a big explanation of how the business works. There's a lot of videos, a lot of resources on that, and you can look. Hayden Capital has done a great write-up on it, so you might want to check that out if you're interested. Not Boring also did a great interview a few years ago. You can look that one up. But basically, they are a huge retailer, online retailer in China, and they have sort of perfected this C2M model, which is customer to manufacturer. They basically have cut out all the middlemen and the distribution and basically just allow manufacturers to sell directly to customers, and that allows them to sell very cheaply because there's no middlemen, there's no extra costs, extra margins going to other people. And Pinduoduo makes that really easy for them. They teach these manufacturers how to sell on their platform. They make it really easy for them to market, to do ads, to create ads, and make the distribution really easy. So they've basically piggybacked on the infrastructure that Alibaba built out. And so I think that's quite interesting. You know, Colin Huang, the CEO, the previous CEO, basically said, "I'm going to take what you made and use it to destroy you." Some quote like that. And I think that's directed at Alibaba. But very low prices. And the key things that they've done to get to the scale they're at is they started in 2015 and they're 900 million users now. That is unbelievably fast growth. And the way they got there was by creating a marketing hack that is basically, this is an all-time winner that's going to be in a lot of textbooks, I think, going forward. But they pioneered this. Well, they didn't pioneer. Maybe they perfected the group buying sort of thing where they said, if you can have one price if you buy one of these items, or you can get a team together and get a much lower price if you can get a bunch of people in to buy this. And so obviously people who use the platform wanted to get the lower price, so they would just bring their friends on. And that's essentially free marketing for free user acquisition for PDD, right? So they've, I should say that this is all kind of built on the back of WeChat, right? So the WeChat was an investor in PDD, and they made this really easy to sort of hook your friends in to the platform and get people on, and that's sort of the backbone of how they grew so fast. So I mean that is an incredible story. The other thing that they did, which I think is really interesting, is they have this sort of hub delivery model where instead of delivering the packages directly to the buyer's door, they have these sort of hubs where the deliveries are made and people pick their package up at these hubs. So imagine a bunch of high rises that are clustered together, and there's a hub at the bottom. Somebody who owns a shop or has a room down there, and they can take delivery of everything, and they get a little commission on the deliveries they take, and then they manage the distribution for there. And so that's a huge deal because the last mile delivery is a huge chunk of the cost of delivery, right? I've read, it's 50 to up to 80% of the cost of delivery is the last mile. So they've cut their costs immensely by figuring this out. Now, those two big wins, one of them is pretty easily copyable. Like the hub delivery model is very, anybody can sort of build that in, bigger cities that are dense. But the group buying actually is, it would be quite difficult to copy, like in a place like the US, right? Because first of all, you're not built on WeChat. There's not this one app that sort of controls everything. So it's a little bit more disjointed. And also there's a lot more competition, but I think the WeChat thing actually is the biggest deal there. So onto financials. The quarter one was, if you look at this quickly, the numbers are unbelievable, right? Revenue's up 58%, expenses are only up 35%, which means the operating margin is quite good. Their operating profit was up 220%. Their gross margin is 70%, and G&A expenses is 2%. Like, this is a great looking income statement and set of growth rates, and the trajectory here is really impressive. This is actually why I got in. I started reading after that quarter one came out and was like, holy cow, this business is really firing on all cylinders, right? And meanwhile, I'm holding Alibaba, and they're just, they're really struggling along to get any kind of like growth traction with their China commerce stuff. Now, granted, they have a bigger base to grow from, but they're the market share donor here, and PDD it looks like they're eating their lunch. And there is a reason for that. I'll actually talk about it later in the thesis part, but there is a reason why I think they're eating their lunch. Okay, so more on the financials, 30 billion in net cash. That's crazy, right? So if you take I bought it just under 90 billion market cap, and so if you take 30 billion off that, the enterprise value was 60 billion when I bought. Right now it's about 100 billion at $80 kind of thing, and the enterprise value would be 70 billion. Now this is pretty crazy when you consider that their trailing 12 months earnings is over 5.3 billion, and to get that at an enterprise value of like 60 billion. And with over 50% growth, like that's a pretty good set of numbers. Now, I would say that I think China valuations should be lower, and they're going to typically be lower. So it's not an apples to apples comparison with something that's in the US. What else do I want to say about financials? Oh, okay. So cash conversion and float. This is pretty important. So I mentioned Colin Huang, who I think is a genius. This guy actually met Warren Buffett a number of years back, and Warren apparently taught him about the concept of float. And now you can look at the balance sheet and the cash flow statement, and you can see that PDD really uses this concept, right? So right now they have three sources of float. One is they have this kind of fraud fund where they make merchants put money in as a kind of a deposit or a bond, so that they can, if there is any fraud, if they're doing anything nefarious, then the company can ding them for that. So that's good on two fronts. It gets them cash, and it also reduces the chance that they're going to sell like counterfeit merchandise. The next source is, well, I should mention how they earn revenue. So PDD makes revenue by the merchants on the site purchasing ads. So they're directed towards their stores. And so that's the primary source of their revenue. But there's also a 0.6% transaction fee, which is meant to cover the transactions on the site. So that's a similar model to Taobao. But with the ads, back to the float. So with the ads, people pay up front for their ads, and then they draw that balance down over time. But there's, the ads create another source of float there. The third source is, and this is the big one, right? So you've heard of negative cash conversion cycle. So people pay up front for the merchandise, and then that's released to the merchants later. And so if you look on their balance sheet, there's 8 billion in, I forget what the account name is. It's payable to merchants or something like that. But if you look on there, there's 8 billion in that account, and that's essentially this part of the float. So the merchants are funding the operation here, as same as something like Amazon. So I have a 3-part thesis here. Now the first part is, and the third part's the most interesting, so I'm going to keep in suspense. So stay with me. The first part is that the valuation is pretty good, right? If you watch my videos, I like the PEG ratio, the forward PEG ratio. So PEG, if anybody doesn't know, PE over growth. And if you look at read Peter Lynch's book, he says, if you can get something that grows at 20%, selling at 10 PE, that's how you make money, right? He makes it really simple. And that would be a PEG of 0.5. So that's sort of what I look for in my as a metric, right? A PEG of 1 is still good, but I think at 0.5, you end up with a margin of safety, right? Because the company can make a mistake, right? So they can either have the growth rate can come in lower than expected, or the profits can come in lower than expected, and you still have a good ratio, right? So if in that example with Peter Lynch, the growth rate could drop to 10%, and you're still at a 10 PE, 10 yield at a 10% growth rate. That's still a decent situation, right? So that company can take a hit. So returning back to PDD, I mentioned that they have over 5.3 billion in trailing 12 months earnings, which means I bought this at 16.5 times earnings. But if you take the cash out and use the EV, that was purchased at an 11 times multiple, EV to net income. Usually it's EV to EBITDA that people look at, but it's all the same, cash in versus price you're paying. So if I take the expected growth rate that the analysts are using at 25%, those PEG ratios come in at 0.65 to 0.44. So they kind of average at about 5, depending on which of the multiples I'm using, right? If I'm using the EV multiple, it's 0.44. I do think growth could be a lot higher than that. They typically exceed the analyst's estimate here. The analysts seem to be kind of out to lunch on this one fairly often. And the current growth rates show that, it might be a lot bigger than that. Plus they have two other big things to come that are going to potentially add a lot of growth. So that's the first part, is the valuation. I think that it's very fairly priced, if not very well priced at this level. I mean, I would have rather buy it at $40 a share, of course. But I can only deal with the hand I'm dealt and what the price is today. So I'm happy with around a 0.5 PEG. The second part of this thesis is that all that valuation stuff doesn't include two huge things that are on the horizon, two potentially monstrous growth arms that are being built right now that I think are free. Okay, so if you look at the US, they've started a site called Temu, which is short for team up, price down. And this thing has grown like crazy since it came on the market in September 22, right? I think it's been the biggest, the most downloaded app in the country since then. Like, granted, all the big apps are already downloaded, but they're already at a level where they have as many users as Shein, right? The huge Chinese clothing company or online clothing retailer that is just, you know, destroying in the US right now. And so they're already at that many users. And there's no sign that this is slowing down in terms of people buying it. Now, I downloaded it myself. I got my wife to use it, and it's pretty good. Like, it's cheap. It's not the same as PDD though. Like, they don't have a group buying option yet. I imagine they may put that in if they can figure out how to do it, but it's a little bit more tricky in the US. But basically, it's just super low price. It's kind of like Shein. Shein is this ultra low cost clothing supplier. You can buy things for $1 to $5. My kids have tried that and they think it's fantastic just because of the price. And of course, in the end, you know, you can have the best products or this or that, but low cost usually gets a lot of users and customers. So they're trying to sort of be the Shein of general purchases, right? And again, I ordered from it. It took quite a while. It took like a week and a half for me to get my stuff. My wife's took about a week, but quality was good. We got what we expected, and it's so cheap. Like, my wife bought a few things, and she's like, can you give me something else to buy? Like, I can't get over the $20 minimum to get the free shipping, right? So it's just like she couldn't actually spend $20. So that shows you how cheap it was. But I do think this has very good potential, and you know, and it's not. I don't think it's included in the valuation at all. Just a little bit more on Temu. It's not quite the same as, like I said, it's not the same as PDD. Basically, they get the merchants in China to ship to a warehouse. They don't ship directly to the customer. They ship to a warehouse in China, and then PDD Temu takes it and deals with the overseas shipping, because they don't want to mess that up, right? It's kind of difficult for you know, a lot of manufacturers and merchants in China to deal with overseas. So they just deal with it themselves. They think if they get the volumes, they can get the shipping cost down, you know, across the ocean and stuff like that. So, and the upside here really is that, unlike Shein, so Shein, like they put their brand on everything and you buy from them. Whereas Temu, you're buying from the merchant, right? So the merchants have their own little stores and little brands on the site. And what that does is that allows Temu to potentially add in advertising, like in China, where the merchants can purchase advertising, so they can push their products in the US. So, I mean, that's the idea. I imagine they're not making any money in the US right now because they don't have the advertising, but they do charge. They actually have instead of the 0.6% transaction fee, they actually have, I think, I wish I could remember, I think it's an 18% gross margin they put on top of it. And that goes to the company to deal with overheads and stuff, because they're actually dealing with shipping and stuff. But lots of potential there if the US customer takes this up and makes this part of their daily routine. Like, watch out, this is the average basket size could be larger, quite a lot larger than the PDD basket size on the China side, just due to the purchasing power difference in the countries. So that's one huge potential upside. Maybe we get it, maybe we don't. The other part of this is grocery. Now, they have the grocery business is typically a low margin business, but the TAM, the total addressable market, is enormous, right? So they're already the largest grocery retailer in the country, and I read that the potential TAM for this sector is 1.2 trillion. I believe that was by 2025. So if they continue to be the biggest and continue to take market share from the sort of traditional grocery stores, and even get like a 2, 3, 4% EBIT margin on that, this could be a big win as well. Okay, this is the most important part of my thesis here. Now, if I'm right about this, then I think this could potentially have a lot of upside. Like I'm talking 10x trillion-dollar valuation if this is actually true. Because if it's true, this could be the new Costco, right? It already gets labeled as Costco. I think it gets labeled as Costco because of the low prices in bulk. But I think that these guys, the crux of this is I think these guys are a scaled economy shared model, and they are almost unassailable. Okay, so let's first define what a scaled economy shared model is. Now, this is the idea that Nick Sleep made famous, buying Costco and Amazon, right? And so, first of all, what are scaled economies, right? So here, I'll read it from the 7 Powers book. If you haven't read that, I suggest you read it. A business in which per unit cost declines as production volume increases, right? So you get bigger, you're able to produce or get your supplies are cheaper just because you can buy them at scale, or you can provide your services at scale, and it creates larger margins if you're just charging the same price because your input costs go down. And so the idea with scaled economies shared is, well, first of all, the moat around a scaled economies business is that if you get attacked by another company that's trying to fight you on price, you have the ability to lower your prices further because your cost is lower, and then you end up pushing your competitor into a negative cash flow situation, which they can't deal with indefinitely, right? So you can win basically you can win a price war if they come up. Now, and that prevents, if other competitors see you have that, it prevents them from trying to attack you. But if you go to the scaled economy shared model, what Nick Sleep is talking about, and the idea that behind this is that they take those additional margins that they get from these scaled economies and they pass them on to the customer to improve the customer's experience, like with price or well, I'll use an example. So it could be price or service or something like that actually makes the experience for the customer better and better, deepening and widening the moat around the business, right? So if we use Costco as an example, Costco they basically see themselves as a buying agent. They buy. I'm going to unplug this. They buy for the customer and basically pass on the cost of the product. They basically pass it on at cost, right? So they have a small margin that they put on there, but that just goes to covering Costco overhead. So Costco basically doesn't make any money on the merchandise they sell, and then they only make money on the what do they call the memberships, right? So it's very difficult to compete with them. First, they could buy at scale because they're so huge, so they get super cheap product, and then they sell it at cost, right? So why would anybody even try to compete with that? You just end up destroying yourself, right? You essentially can't compete with that unless you come up with a brand new model that sort of breaks the mold. Now, speaking of breaking the mold, I think that's what PDD's done, and I've created a new version of these scaled economies shared. Now, it doesn't have to be, well, actually, hold on a second. So they created a new one based on this customer to manufacturer model. So basically, they've cut out every cost that they can in between. It just goes from the customer to the manufacturer. It doesn't go through any middlemen, any distributors, anybody's trying to make a margin. If you look on something like Taobao, a lot of people on Taobao are middlemen, right? So they're people who buy product and then they try and resell it on Taobao and then cut themselves in for a little bit of the pie. But that makes the end price higher than you would get on PDD. Right now, Taobao Deals is different because that is a C2M model as well. But traditional Taobao is kind of is getting undercut here by PDD. And they do that because the main hurdle previously was the manufacturers didn't know how to sell their stuff, right? So they needed these people in the middle to get their product to market. But PDD has solved that problem and reshaped the industry, basically. Okay, so now why do I think they're a scaled economy shared model, right? So when I read about PDD, one of the big risks that people usually bring up that I've read is that they have these huge discounts. Now, I didn't talk about this before when I was talking about the income statement, but on the income statement, there's about 40% of their revenue that's sales and marketing, and a lot of that is direct discounts to the customer. So the customer, like if you go even just on Temu, it's like you open it up, it's like get 20% off whatever you want. Okay, and then you do that. And that's the company subsidizing the purchase, right? So that doesn't get dinged to the merchant, that gets dinged to PDD or Temu. And the risk is everyone's saying, this is going to have to go away at some point. People are going to have to stop, they're going to have to stop subsidizing all these purchases. And then where are you at, right? Kind of like Uber, right? Uber subsidized all their rides to gain market share, but they're running at a loss. So they're like, okay, you got to get rid of that. Are you actually a business, or are you just paying people cash to use your business, right? Now, the thing that I think people miss here is that they don't need the discounts to go away. So if we analyze the income statement, these guys are still producing the trailing 12-month earnings. They have a 25% net income after the discounts. Right, so they've applied the discounts, and they're still making like world-beating profit margins on this work. So my contention is that the discounts are actually good. So what they're doing is they're saying, here's this ultra low cost model. You buy directly from the manufacturers, get the lowest possible price because you're buying in bulk, and you know what? We'll discount on top of that. I don't even know how you compete with that, right? You're like, let's say you're trying to compete with that. Like, how do you make a margin if you compete with that? I don't know how you do. I can't think of it. Like, and I think that Alibaba is the only one who has a chance of even fighting them on that, because they have such deep pockets and they already have connection to over 1 billion users. But it's still pretty hard, because Alibaba, they have a lot more corporate overheads than PDD does. And I should mention this because this is really important. I said it before, the G&A expense is 2%, 2% of revenue. So this is a lean company. They are cheap and they're lean, and they are operating on a shoestring. Right. So on top of that ultra low cost from the manufacturer, you've got a company that's running ultra lean too. Right. So they have all this extra cash flow to work with. Right. So even if you go to war with them, they go, okay, we still have 25%. We can cut our prices and still be above water. Right. So backing up, advertising and transaction revenue, 30% of that is gross cost of goods sold. So the gross margin is 70%. Then they have 2% G&A expense. They've still got 68% of their revenue to do whatever they want with, right? They take 6-7% of that, put it in R&D. That's potentially a revenue building expense. That's a good expense. And then they put 40% in to these discounts to entrench the customers, because why would you go anywhere else if you're getting these discounts every time you buy? They're still making money on it because of the advertising revenues because all the customers are there. Like, I think this is just win-win all around. The merchants make more money on this platform than they do anywhere else. I think that's my understanding, because they can raise their prices a bit because they don't have to account for all the additional costs they would have with the distribution and all that, or sorry, the middlemen and stuff, right? So they actually make more money on PDD. The customer pays less. Everyone's winning here, and then PDD gets the revenue from the advertising. Like, this is a win-win all around, and I'm blown away. So I really would like to request that if you think I'm wrong, please tell me why. Put some links into counter arguments, because I just think this is a phenomenal model, and it looks like it could be impenetrable, like Costco, in a different way. Of course, it's not Costco, but pretty tough to fight with these guys. So that being said, I should talk about some risks too, right? So obviously, the obvious risk, anything Chinese, you're going to come up with government regulation. You don't know what they're going to do. That's a risk. Probably pay less for this, comparable stock than you would in the US. They have the VIE model thing, which I don't think is a real problem. I only think that's a problem if you're in a war and they just say, okay, all foreign ownership is gone. But the Chinese government's not stupid. They want foreign ownership. They know that it's good for their businesses. They're not just gonna say, "Oh, sorry, you don't own anything." Like, they know that that'd be financial suicide. So yes, government risk. VIE, I don't think it's a risk. The other risk is Alibaba could catch up to them. They could get Taobao deals to this same level and start a price war. I don't know how good that would be for Alibaba, but they are up to over 300 million users in Taobao deals, and not very long, right? And they do have access to a huge customer base. But I don't know why people would switch away from PDD if they're already using it. So I just don't understand what the benefit is. Maybe Baba can put in some value adds there. But anyway, it's a risk. Competition in China is fierce, and nobody's just going to roll over and die. One thing, the risk that I think is more relevant is watching the cost levels, right? This is dependent on the G&A and the gross margins being really strong. If the G&A expense started to balloon to 5, 6, 10%, then I'd start to be worried, because that's eroding their ability to maintain this moat. So cost levels, that's what I'm watching. And geopolitical noise, you might get some problems running into a US election. Everybody might start bashing on China again, as they do. And so for me, I'm comfortable at holding my max portfolio at portfolio allocation at 20% of China. So for that reason, I moved some of Alibaba over to PDD, and I had a bit of room left to work with, so I just bought there. I also may move towards more of what do they call it? Just a basket model, right? Like, I might add some Tencent or some other stocks that I've been following in China, just to sort of diversify away from the individual company risk. I'm not sure yet, but I may in the future. I think that's pretty much it for risks. There's some other ones too, right? I guess, like, technological advancement. Somebody might, make a better mousetrap, like PDD's done. There's a lot of brains working on this, so maybe somebody will come up with something soon. The last thing I would say is, here's a little bit of a bonus for anything China. Now, China's been in the toilet for 2 years now, and I think the macro picture might change for them, right? We've come out of the lockdowns, that's one, and everyone's going, what's going on? Nothing got better. It's going to get better. It will. And, you can't just close your economy and then open it and not have any benefits, right? Like, it's coming. It's just a big ocean liner that's moving. It's not a quick, it's not a race car. It's an ocean liner. But the big one I see is that actually it looks like they've started cutting interest rates. And as you know, interest rates will have an inverse relationship on asset prices. And if this is the beginning of a trend, you may see Chinese stocks generally, start rising as they cut rates. Depends how aggressive the central bank is in China, but that could be a bonus upside too. Well, it's been a very long video. Thanks for sticking with me. If you made it this far, if you want to hit like, that would be awesome. If not, don't worry about it. And I hope you got something from that. We'll catch you in the next video, guys. Thanks.